The money market rate is a key part of a country's monetary policy that aims to promote maximum employment and stable prices, among other things. When very strong deflationary forces are present, banks may choose to have a money market rate to stabilize the economy. The purpose of setting the money market rate below zero is to encourage spending and borrowing in times of economic uncertainty or crisis, where depositors prefer to hold their wealth. Negative rate will also devalue the currency of the country, which can prevent foreign interference of the economy. For example, the first central bank to lower their cash rate beyond zero after the 2008 global financial crisis was Sweden's central bank. They did this to prevent hot money cash flow into the economy. The Reserve Bank of New Zealand should not drop the official cash rate to zero or below.
The following part is explaining how the Reserve Bank controls the money rate. The New Zealand Reserve Bank will use open market operation to control the monetary when the New Zealand Reserve Banks are deciding whether to sell or buy short-term treasury bonds. The action is to manipulate OCR rate. It depends on the economic environment. The next step of OCR rate can avoid the wrong decision or mistakes. In addition, we will provide evidence to support our states. Maintaining OCR 1% can make a stable of economy and it can minimize the unemployment. However, if the OCR rate is decreasing to zero or becoming higher, it will impact on a series of events. Although the interest rate is becoming low, it will stimulate the consumers to spend more on the service and food. Therefore, a part of people who had fixed income will lose their pension fund. This will make them to have losses. However, inflation rate will make a booming when the economy grows rapidly. As a result, it will lead them to have economic collapse.
Secondly, the negative interest rate will also affect New Zealand housing market. Lowering the OCR may cause an overheated economy. In the long run, people cannot afford to buy house as the raise of the average salary will fail to follow up the bond of the housing price. The negative OCR rate may cause the bond of the housing price. When the interest rate is low, people are more willing to borrow money and make big purchases, such as house and car. They have higher purchase power as they borrow more money to spend and only need to pay a little interest. Lots of people looking to borrow mortgage for property investment. It will cause the house price increase as the demand over the supply. Some investors may also overestimate their ability of debt repayment. It is possible that the New Zealand housing market will potentially collapse and crash as a result, similar to 2008 US housing bubble economy. Thus, the New Zealand economy has to bear the potential pain and loss from it.
Opposite side, setting the lower OCR indicates that New Zealand is given the great opportunity for the short-term economic surge. Moreover, when the Reserve Bank chooses to lower the OCR, it could minimize the cost of loans as well as promoting domestic spending. With the lower interest rate, small and medium businesses are encouraged to borrow more capitals from the banks, which is stimulating business expansion. As a result, it creates a ripple effect of increased spending throughout the economy. In conclusion, after we analyze different points of view above, we are strongly against the proposal for lowering the OCR to zero or even negative, even though the surge of economic growth might be effective for a short-term period. However, in the long run, negative OCR might cause New Zealand to experience economic collapse in the future.